institution.
I understand, but this is the vice president himself talking about decisions on interest rates and doing so without input from the people who were elected. The chief executive, members of Congress. Where does it stop?
That's the concern. I completely agree with you. Look, I've been trained by evidence that shows that an independent central bank is in the interest of good economic outcome. I've also been trained by data that shows that central banks learn, they evolve, they're open to reform themselves, they ask questions, they own their mistakes, they get external views. The Fed has not done that. And unfortunately, this is catching up with it at a time when the political attacks are deepening and widening. So yes, I am really worried that we may risk something here that is really important to good economic well-being. But the critical issue is to get a new Fed chair in there who's committed to reforms, because the most established people agree that the Fed need reforms, and to get moving and to somehow avoid this increasing political attack.
Do you find it in any way ironic that the people who are arguing for rate cuts essentially arguing that inflation caused by tariffs is transitory, of all words? It's not permanent. At the same time, some of the same have criticized the Fed chair in the past for being wrong on that very issue. Is there any irony in that?
I mean, there is an irony, but these are very different circumstances. I am among those who believe the price effects of higher tariffs are not going to be a major inflationary shock. But I also, in 2021, was criticizing the Fed chair for rushing to the transitory inflation. These are very different circumstances, but the biggest difference is the labor market. The labor market today is weakening. I thought that Governor Waller had a really good explanation for why you have to go beyond the one number that Chair Powell is focused on, the unemployment rate, and look at the internal dynamics of the labor force and the labor market. It is weakening. That's the argument that says, you know what, we should get ahead of this by cutting, and we should have cut in July. Now, the inflation arguments are twofold. One, they're transitory, and Governor Waller did say, I'm back in camp transitory. That was his phrase. Mm-hmm. And the other view, which I know you don't like discussing, but we're getting evidence day in and day out, is what is the right equilibrium inflation rate for this economy that is going through so many structural changes?
Well, I don't know why you suggest I don't like discussing. I mean, just because I give you a counterpoint to your argument doesn't mean I don't like discussing it. In fact, I want to discuss it further because I want to know from you. I'm looking at stocks at record highs as we enter the fall, right? GDP for the quarter was just revised up to 3.3%. You make the argument, others have made the argument that inflation's transitory. Core PCE was up in July, right? What Fed would ever cut in that environment? What?
Okay,
Which one?
So this Fed will cut in that environment. I mean, here's the irony. And the market gives it an 85% probability that this Fed will cut. And it's worse. If you want to go down the line of argument you just cited, PCE core inflation will go up above 3% in the next few months. Goods inflation will pick up. Service inflation has picked up. And it's very likely we're going to go up above 3%. So the whole point is you're supposed to look forward and ask yourself, of the two risks right now, higher inflation that de-anchors inflationary expectation, and that's a critical phrase, employment, where the labor market sees the bottom falling out of it. What is the greater risk of these two? My judgment, Waller is there, some others are there. It is the labor side that's the bigger risk. It doesn't mean the inflation isn't a risk, but you worry about the labor side more. And that's why the market is pricing in 85% probability.
That's why Waller says, quote, get on with it, right? His point is yours. Why wait for things to deteriorate? And others would make the case that maybe the Fed is, in fact, in the insurance business of sorts. And there's nothing wrong with that, because if you wait too long, then, of course, you're behind the curve. and then you're late, and then you're subject to all sorts of other issues that may result from a policy error. Mohammed, I'm going to let you run. I appreciate it very much, as always. I do like the discussion. Thank you.
Thank you, Scott. I like them too.
Mohammed El-Arian. The week's other big story, of course, probably maybe more important for investors right now as August comes to a close, the future of the AI trade following NVIDIA's earnings. Christina Partsenevelos joins us now with more. What was our big takeaway, do you think, this week from NVIDIA?
From NVIDIA, I guess the big takeaway is that demand is still expected to be exponentially higher. And that's because when we often talk about AI, we talk about training, right? You study for an exam, you look at all the textbooks, you study from them. That's like training. The next part of it is inferencing. When you actually have to do the exam, think about complex answers and write them out. So that's like how I would compare it to. The problem is, you have investors that have gotten into this stock. It's run up higher than the S&P 500. You've seen phenomenal growth in data centers, especially for NVIDIA. That growth is starting to decelerate. And so I would say that people are just taking a breather right now. There's no major catalyst aside from Broadcom next week. You have the CEOs and CFOs of a lot of chip names that are going to be speaking at tech conferences in the coming week. But the biggest takeaway for NVIDIA from them is that the next leg of demand is going to be incredibly strong. It's just patience, you know? Are you getting into this name to hold it for a really long time, or are you getting in and trying to get out? And so that's the relief or the drop that you're seeing just over the last few days.
So if we take NVIDIA then to the next layer on the AI trade in general, because we did hear from some other companies as well this week that are critically important too, to investors, no less. What was our takeaway then from all of that as we think about what these stocks might do as a whole in a new month?
Well, the ones I can think of off the top of my head were just Dell yesterday. Their AI shipments were incredibly strong, so still adding to that AI narrative, the things people or companies are spending. Marvell is a custom chip maker, a little bit less so, but it's very company specific. They were hurt on the data center side, some custom chip business, possibly with Microsoft hurting some of their numbers. But overall, it seems like the narrative is still there. However, there are several headlines in the media just this week alone that are, having people think, is the AI capex bubble going to burst? And I say that specifically from news coming from China. You mentioned it at the top of the show, right? Alibaba creating its own chip. That's not good news for NVIDIA, right? Because it's a $50 billion market, according to Jensen Huang, the CEO. NVIDIA could be losing all of it if it goes to a company like Capricorn, a company like Alibaba, a company like Huawei. And so I think that narrative keeps coming up. These headlines keep popping up. And so that's creating some anxiety for investors that are so heavily in the AI trade.
Good stuff. Christina, thanks. Christina Partsenevelos setting the table for us. Now let's bring in Anastasia Amoroso, Partners Group Chief Investment Strategist for Private Wealth and Retirement. It's nice to see you.
Good to see you, Scott.
All right, so we dealt with the two biggest issues this week. Where do they stack in your mind to setting us up for what might take place in the next few weeks, months?
Well, to me, the question of Fed independence is an ongoing question, but I don't think it is the key driver for the markets. I think it's really about whether we do get that rate cut in September and a couple of more this year. That's really the key determinant. And the second one is this question whether AI momentum is decelerating. And I'm certainly not in that camp. I think quite the opposite. We're still accelerating. So those are the two most important questions. My take is that we do see that rate cut in September. Mohammed said it's 87% probability. I think we go higher than that. We realize because it is all about the labor market weakness, Scott. We go into next week. We're looking at a lot of jobs data that's coming out, and I think it's going to confirm the story that we've been seeing in August, which is labor market is sort of on this precipice of weakness. And if we don't want to go there, we have to deliver the rate cut.
Well, we'll get the jobs report next week. So, we got PCE, and now we're going to get another read right in our faces.
That's
that
right.
may help us answer that question.
I think it will. So first point on PCE, I actually found it to be incredibly encouraging, and I think it actually sealed the deal on the September rate cut.
Oh, is that right? Okay.
That's right. And I say that because the core goods inflation is clearly rising, but everybody knows it. Everybody expects it. But what actually didn't rise are all the other categories within PCE. And for example, if you look at services inflation is running about 2.5%. Guess what? It was running at 2.5% year over year this time last year when the Fed embarked on the rate cut. Also, if you look at gasoline prices, they're declining. Food costs, they're sort of stable. So I think the Fed is likely to look at this and say, we don't have this pervasive rise in inflation that's sort of infecting other parts of the economy outside of goods.
Let's leave the Fed and go back to AI, because you said there still is a lot of momentum. Of course, there's momentum around the investing, the spending, and the idea that this is going to continue to be an investable place and a good place to be. All of that is different from whether the stocks are going to continue to work as well as they have after sputtering a bit this month. No, what does that movement, the price action in the names, tell you about your whole idea of where we are?
Well, I think it's readjustment to the fact that the growth rates are slowing down. So the reason why investors on the surface were disappointed with NVIDIA is because top line is not growing at over 200% year over year as it was. It's growing at maybe 50 or 60%. But I think what's really encouraging, Scott, and to your point, should continue to drive stock performance of the beneficiaries is the fact that hyperscaler CapEx next year is projected to be $400 billion. A couple of years ago, it wasn't even $100 billion. So that's still all of that is to come. Some of that will be allocated to NVIDIA chips and some of the others, but a lot of it will be allocated to things like data centers. And it's not just putting up a box, but it's putting up the connectivity, it's putting up the cooling, it's putting up, a lot of the services that go along with it. So I think as the total addressable market growth materializes, that's what ultimately drives those stocks higher.
The derivative on both fronts, right, of Fed cuts and AI trade is what happens with the broadening trade. Fed cuts seemingly good for the 493, right, so to speak. The AI trade, depending on how that goes, is going to determine in some respects how that broadening trade goes as well.
Yeah. Well, let's talk about the broadening of the AI trade first. Actually, it's clearly been all about the semiconductors. And look, we're still looking for something like a 40% CAGR in terms of semiconductor total addressable market growth. But, Scott, if you look at what's actually likely to outpace that growth, it's actually the business application software. And I think that's what investors are starting to rotate to and will continue. So that's the broadening of AI. I think investors have to consider that, what's out there beyond NVIDIA. By the way, a lot of it is out there in private markets as well. So that's the first point. The second point is I do think there's the broadening of trade to talk about as well. And consumer could actually be a very significant beneficiary of it because you saw the spending numbers today, they're solid. And if on top of that, we do get the catalyst of a rate cut to cushion the labor market, that could definitely be supportive.
Are you one of those who argue small caps are going to have their moment? Because I feel like that crowd is kind of growing larger against a backdrop that may not be so stimulative for that trade.
I'm one of those people who thinks private equity, middle market growth companies will have their moment. And that's what we see clients increasingly look to is not the small cap allocations, but what can they do in private markets? And Scott, one of the reasons for that is that if you actually look at the earnings growth in some of those PE-backed companies, it's about double what you see, for example, in the public markets. If you look at the margins in some of those PE-backed companies, they're actually more robust, more resilient, and we have the ability to build those margins over time. So I would say a lot of clients are looking to the private markets for those allocations versus the publicly traded small caps.
Russell 2000's had its longest monthly win streak since 2021.
We'll take it.
That surprise you?
No, it doesn't. First of all, it's all about the rate cuts, and that has been supportive. And, if I look at the coverage ratios, for example, they have troughed at about 1.5 times as the Fed cut rates that improved to 1.8. As we expect the Fed to cut more, they're going to improve further. So that's been a big boost, I think, for small caps.
Right.
But it's about earnings growth.
All right, have a good long weekend. And
Thanks
we'll see you
so
soon.
much.
Anastasia Amoroso. We're just getting started here. Up next, owning the runway. Surprising new numbers on who's really winning over the high-end consumer and the impact on investors. You might be surprised by what we're about to tell you next. We're at the New York Stock Exchange. You're watching Closing Bell on CNBC.
Tune famous to bold.
We are back on the bell. It was a mixed bag for retail earnings this week, with several lower-end names outperforming. And speaking of outperforming, that's exactly what some higher-end brands in the U.S. have been doing to their European luxury counterparts. Courtney Reagan joins us now with more. It's good to see you. You know, I saw this piece in the Journal today, and it surprised me. It said, "Sorry, Europe, American luxury brands are in," and it showed how high-end U.S. fashion houses are outperforming their European counterparts in total annual shareholder return over the last 5 years. And frankly, it's not even that close. Should we be surprised by that? And why do you think this is?
Yeah, I mean, I don't think so if you pay attention to what's actually going on under the surface of some of these brands. But I don't know, maybe it is a American luxuries brand way of coming back with their own hit on the quiet luxury trend. But if you look at a name like Ralph Lauren or Tapestry, which I'll remind you owns Coach and Kate Spade and Stuart Weitzman, I mean, the management companies there have really been working through a lot of sort of changes at the fundamental level. Ralph Lauren, especially, Patrice Louvet has been there for a number of years, but it's taken a while to sort of reinvent that company. Remember, Ralph Lauren himself was at the helm for a while and handed over the reins somewhat temporarily to Stefan Larsson, who ultimately ended up at PVH, before Patrice Louvet stepped in and really took his time examining the company and saying, look, this is a strong American brand. We got to fix the operation so the brand can really shine. And that's what's happening. They've been able to drive up AUR, the average unit retail. So that certainly helps with things like margins, but also with that brand halo, with the equity, right? You don't water down the brand so much that it's available anywhere to anyone, which frankly is sort of part of the tenets of what luxury is. Now, I would argue that Ralph Lauren and Coach are not exactly luxury the way Hermes is, but not everyone can afford an Hermes bag, and I think that's where they're winning. They're able to introduce a high-quality piece to someone that maybe either doesn't want to spend thousands of dollars or a bag, or maybe can't, but still feels like they're getting a quality piece that's fairly special.
The point on that, too, is what the retailing legend Mickey Drexler was discussing yesterday with me right here, where he said the high end is extremely high end. And I think people wear less expensive. In other words, kind of to your point, the U.S. luxury brands have made themselves feel more luxurious in a way without having prices to match what's coming out of Europe. And in the current environment we're in, that's made a huge difference.
Absolutely. I think there was a number of years where everything was splashed with a lot of logos, and that's gone away a little bit, and more of that reintroduction of quality hardware or leather, which then also, you know, kind of ups the classicness, say, of a bag, which then may sort of say, hey, maybe I can invest a little bit more money in this, but am I really going to spend $5,000, $10,000 on a bag when most of the time I don't even wear dresses or suits or blazers anymore? I mean, think about that too, right? There's some level of casualization of many of us in the way that we live and work. And so maybe it doesn't make sense to spend that much money on a super high-end piece, but you still want to have something special. And also, there's a lot of value in grabbing a younger consumer and maybe their first big purchase. I remember the first, I'll call it, you know, nice handbag that I ever bought. And it was an introduction to those brands. And there's also this nostalgia value that is really hard to put a price on. And so I think that is something valuable when you retain a customer for a lifetime, too. And I think that's what some of these American brands have done. Now, one thing I've been a little surprised about is everything that's going on here in the United States with sort of our nationalistic policies under President Trump is that there hasn't been more discernible backlash against very American brands internationally. I mean, when I think of American brands, Ralph Lauren is very, very high in the top, especially with that very identifiable polo. And so I think we just want to watch out for that a little bit as things continue.
Last question. Bank of America says American consumers are spending the lowest share of discretionary income on luxury since 2019. On that note, what's your takeaway this week then from the retail numbers that were delivered? Because it seems as though, like I said in the intro here, the lower end is faring pretty well. I mean, Five Below, TJX, Dollar General. What's your take?
Yeah, absolutely. I think, look, times are tough. I would overall say I'm pretty impressed with how retailers have been able to manage through a very difficult macroeconomic environment, the cost pressures that they're having. But at the same time, the consumer's shown that they're willing to spend when you give them something that's worth their money. So even some of the middle market players have found success when they're talking about innovative products or new fashion. But if you're going to offer me something basic, I'm not going to pay any more for it than what I really think I need to, which is why I think you're seeing Walmart continue to win. And to bring the whole conversation around, they've captured this higher income consumer, maybe with their grocery offering, but they've kept them in to switch over to general merchandise because those numbers are actually improving too.
All right, good stuff, Court. Thanks. Courtney Reagan with the Retail Insight. Up next, your September setup. Top strategist Ryan Dietrich is back. Where is the market going in what has been a historically rough month? His take next. We're back. What will September hold for the markets? Ryan Dietrich is Carson Group Chief Market Strategist. Sounds to me as, thank you for coming back, much of the same story. This bull market rolls on.
Yeah, we think so, Scott. Thanks for having me back. Happy long weekend, everyone, and good luck if you're trying to win $1 billion in Powerball this weekend. Listen, overall, we're still bullish, yes. But I do want to talk about September for a second because I know lots of people are going to be pointing this stuff out. Since 1950, it is the worst month on average. The last 10 years, again, the worst month. The last 20 years, the worst month. And in a post-election year, it's like the third worst month. Now, one more thing to think about. I get it. August obviously was higher. This will be the first time August was higher with a second-term president going back to like World War II. But it is rare, Scott, to see August and September both higher in a post-election year. It's only happened 3 times going back to the last 18, 4-year cycles. So we're still in a bull market, yes, but I wouldn't be shocked if we had a little bit of kind of seasonal weakness, and we can get into kind of why. But I think it's possible after a 30% rally and a 4-month win streak here.
I know, but in all of that, including the wishing good luck for the Powerball and all that, I don't think I heard a reason as to why the market's going to continue to go up into the fall. Why September won't have a historical repeat.
Yeah, well, listen, I'm a big message of the markets person, right? Like, what's the market telling us? Well, if you look at kind of the leadership, I love it. What's even lagging, I even like more. Look at Staples. Staples relative to the S&P 500 is making like new lows right now. You want that area to lag. On the offensive side, you've got like high beta, some of those things doing very, very well. Obviously, consumer discretionary relative to Staples. So the message is still very solid. Now, one more thing. I know last week I didn't get to join you, but last week was a 90-90 day. Meaning 90% of the stocks, this is last Friday, 90% of the stocks on the New York Stock Exchange were higher and 90% of the volume. That is extremely rare. Going back to 1980, it's only happened 12 other times, Scott. A year later, S&P is up 11 times and up over 20% on average, even stronger returns in the near term. So if we have a little seasonal weakness after a 30% rally, I think it's going to be contained, say 4 to 6%. And there's still a lot of reasons the underlying pinnings that got us to this bull market are still healthy.
So you don't really buy the broadening, it sounds. I mean, beyond what we've already had from a big cap standpoint. If you want us to stay overweight industrials, financials, and technology, in other words, stay the course, don't overcomplicate it.
That's right. I know small caps had a heck of a rally. We get it. But, Amorosa and you just had a great discussion about kind of the PC. I'll take the other side of this. We're a little more Anastasia, sorry. We're taking the other side of this, though. If you look at like 178 components of core PCE, 45% of them are above 3%. What in the world does that mean? It was 40% at the start of the year. So we are seeing more of a broadening out on inflation. So what I'm getting at, the Fed's probably going to cut a couple times. We know that's coming. Maybe they don't cut the 6 times that are priced in over the next 16 months because inflation's a little higher. And what does that mean? Well, probably stick with who brought you to the dance, those large caps and, again, industrials, financials. And small caps are an area we have exposure, yes, but we're not overweight small and mid caps here.
Does the Fed cut in 2.5 weeks?
Yeah, we think so. We think so. And you had some other great discussions before I came on. I think the stage is set there because they kind of have to, I think, for lack of a better word. We were the camp, I think I came on earlier this year, saying they should have been cutting back in the first quarter. Then they didn't. Then tariffs happened. But, there are some worrisome parts of inflation. But the reality is, yes, the labor market is obviously weakening, as everyone's been talking about. So it makes sense. We don't need 4.5% interest rates right here, Scott. We think, probably 2 more cuts this year, and then we'll see what happens next year.
Ryan, we'll see you soon. Have a good long weekend. Ryan Dietrich.
Appreciate it. Thank you.
Coming up next, we track the biggest movers into the close. Christina Partsinevelos is standing by with that. Tell us what you see.
Well, we have big moves today. A food company rockets higher on breakup buzz. A computer maker falls on margin concerns, and industrial stocks are flashing warning signs. We'll break it all down after this break. Happy Friday.
invest.
All right, we're about 15 from the bell. Let's get back to Christina now for the stocks that she's watching. Tell us, please.
I have a few. Kraft Heinz on the rise today after a Wall Street Journal report that the company could announce a breakup as soon as next week. It would be the latest high-profile split in the space. Keurig Dr. Pepper announced a split earlier this week, and that's why shares of Kraft are up almost 3%. Meantime, Dell is tumbling despite actually a Q2 beat and increasing its guidance, its gross margins that missed estimates as Dell focused on rapid AI server growth, and with growth comes a cost. Analysts at Morgan Stanley called it an empty calorie story where every billion in AI revenue just adds less than 10 cents to earnings. Shares down 9%. Last but not least, Caterpillar shares falling after announcing a $1.5 to $1.8 billion hit from tariffs for 2025. That is a higher number than what they said just a few weeks ago on their earnings call. It could also be an early indicator of industry challenges as manufacturing companies face pressure from rising steel and aluminum prices. Caterpillar down almost 4%.
All right,
Scott,
Christina.
it's the weekend.
Yay. Enjoy
God,
it.
you could be more enthusiastic than that.
Well, I mean, I'm thinking about the other things I still have coming up in the show. I wasn't
Yeah, so do
prepared for
I. I'm sitting here. Sorry, go ahead.
the level of enthusiasm you had. Obviously, you're done with.
No, I'm not. I'm going to do
show.
a markets hit at 4. But have a great weekend, everyone
All
that's
right,
watching.
will you stay focused for that? Thank you, Christina Porcinellos. Still ahead, game on. Sports betting's biggest season about to get underway. Contessa Brewer breaks down the stakes. All right, coming up next, your September setup for crypto following Bitcoin's losing month. We'll do that in the market zone, which is next. We're now in the closing bell market zone. Mackenzie Sigalos is here with crypto's September setup. And Tessa Brewer tracking what could be a big uptick in sports betting. Thank you, NFL. And Robinhood's Stephanie Gill breaks down the final moments of this trading day, looking ahead to a new month. And we're glad to have everybody with us. Mackenzie, you first. What is the setup now into the fall for crypto?
So, Scott, it has been a rough August for Bitcoin. It's now given up all of its summer gains. And Ether, which started the week hitting a record high near $5,000, is now outpacing Bitcoin's losses since Monday. But zoom out, and Ether is still the outperformer, up more than 14% in August, while Bitcoin is down nearly 9%. Now, those corporate treasury stocks mostly took a hit this month as well. ETHZilla, backed by Peter Thiel and SharpLink Gaming, both Ether plays, falling in August. MicroStrategy, which tracks Bitcoin, also lower. The big exception here was Tom Lee's BitMine Immersion, which is an Ether proxy trade, but it's up 37%. Now, on the institutional side, ETF volume has been light. Net inflows into spot Bitcoin funds at about $500 million since Monday. And then looking ahead to September, investors are watching macro data and hoping a mid-month rate cut could give crypto a fresh tailwind to trade on. Scott?
Mackenzie, thank you very much. Mackenzie Sigalos. Sports bettings, big season about to kick off, right? NFL
Kind of
season.
sounds like it right here on the
Yeah,
trading
there was
floor,
a blowing
doesn't
a
it?
whistle
Yeah,
over
right.
there.
Like it.
It
Look,
startled us for a moment.
this is a big opportunity for the sports books. It's a big opportunity for them to win new customers. It's a big opportunity for them to grow the pot of wagers. And the industry is now expecting an 8.5% increase in handle. Americans expected to wager $30 billion this NFL season, according to the American Gaming Association. If you say handle to your friends this weekend, you'll sound like a gaming expert. The lion's share of that will go to FanDuel, owned by Flutter, and DraftKings. Those two dominate this space, and both are seeing double-digit gains in their stock price this year. But they're facing growing competition from BetMGM, which is jointly owned by MGM and Entain. And after losing ground for a couple years in terms of market share, BetMGM has now reversed course. It's in solid third place. It's showing profits that pleasantly surprise the street. And Caesars is also posting profits in its digital space, but its shares stand out from the crowd this year. Year to date, down almost 20% when the competitors are up double digits. So keep your eye out for that. And of course, we know that the predictions markets coming in, Robinhood, Kalshi, Crypto.com has a separate tab up there, Polymarket. I mean, that could be big business.
With numbers like you said, up 8.5%, I think was the number. Where's the marketing spend for these companies, which has been long criticized as spending so much money? The acquisition cost, I think they call it, or something like that?
Yeah, customer acquisition costs.
Where are we on that?
Much more restrained.
Oh, that's what I was wondering.
And they're using better algorithms and maybe AI to help them better target customers. So they're not going to be offering, bet $200 and win $1,000. It's going to be, if you're a small time bettor, you're not going to get the same kind of promotions that you once did.
That's what I was wondering. Thanks for answering the question. Contessa Brewer. Thank you very much. Speaking of Robinhood, Stephanie Guild is with us right now, the Chief Investment Officer. It's always good to have you on the program. What's your take on where we're going here in a new month?
I mean, I think we're at a point in the market where we've seen a lot of gains, and obviously you've had some news out that is starting to show that perhaps valuations have reached expectations. And I think we're at the point in the market where, my target was 6,500, and I think we're going to just grind around here. You always get to a point where things are going to consolidate, and that's where I think we are. So I think the S&P is going to have a tough time getting much higher. But below the surface, there's a lot of movement. And, we're seeing that in tech versus financials today, for example. And that's where I think that's why I think you're going to have a hard time seeing the S&P really rally much higher. And obviously, there's a lot of other drama coming up between tariffs and as the Fed turns, as we like to say. So, I think there's a lot of reasons why I think I would be a little bit more cautious going into next week. But I still think longer term, earnings are there. And obviously, if we continue to get more rate cuts, depends on the reason, though.
On the earnings front, did you come away from NVIDIA feeling just fine about where the AI trade is heading from here? It's hugely popular with the cohort that Robinhood represents, obviously.
Yeah, I mean, our customers tend to trade around it, so it's been a place that they, have been adding on this dip. But I think from a fundamental perspective, the earnings showed that they still have a very strong business. There's a lot of questions about their business in China, which makes up about 12% of their revenues, or has historically. But I think there's the fundamentals are still strong. It's just all about expectations, and expectations have met where they are. They're just not beating as much as they used to.
I mean, there's the debate over whether what we witnessed this month in terms of stock performance is a precursor to what lies ahead. Now, that's not necessarily a bad thing for the market if you get a sizable enough rotation from AI-related stocks into more broad areas of the market. How do you feel about that?
Yeah, I think the rotation actually started at the beginning of July. And you kind of see it even in our flows at Robinhood, and you kind of see it in the way markets have been moving. And I think that rotation has just been a little hesitant here and there because you still have growth in the tech sector, and there's still a lot of opportunity. Maybe not necessarily in the biggest names, but certainly in some of the the small, maybe the mid cap or just not as well owned names like Pure Storage yesterday, obviously really trounced expectations. So I think that rotation will continue through September and through the end of the year. But I wouldn't be surprised to see a bit of a correction or consolidation starting, in September.
Do you like financials as much as everybody else seems to?
I do like financials, but we've been biased towards regional banks because they seem cheaper. I also think they could end up benefiting from deregulation a little more, perhaps a steeper yield curve, and also M&A. I think that's where they'll end up seeing maybe a little bit more positive there than in the large cap space.
Well, that makes me think that do you translate that into liking small caps overall? Because a lot of the regionals fall into that category, no?
Not as much. I still get a little worried about the overall, just buying broad-based small caps because I just think there's still an issue with debt. I don't think you're going to see long end of the curve come down a lot, and there tends to be a little more debt on average in the small cap space. So I tend to like the mid cap. I kind of call them the ignored middle child, but I prefer mid cap space.
All right, we'll talk to you soon, Stephanie. Thanks, Stephanie Guild. Joining us with Robinhood. We're approaching the close. It's going to be a red one for certain. Across the board here, a lot of chip names under pressure today. NVIDIA really hasn't traded all that well from its earnings. Some of the other names in that universe, AMD, Broadcom, Micron, for example, lower. That journal story today talking about Alibaba coming up with its new chip to make up for the void of NVIDIA in China. Seems to be weighing on that space. So there's the bell. Ringing in the long weekend. We'll see you on the other side for what is going to be a new trading month into overtime. It's on course.
That bell marks the end of regulation. New York City Parks Department ringing the closing bell at the New York Stock Exchange. DeFi Development doing the honors at the NASDAQ, and it's a down day for the markets. The Dow is off about 125 points, I believe. S&P 500 down about 1%, nearly. NASDAQ getting the worst of it, falling about 1.25%. NVIDIA pulling back 3.5% after its results on Wednesday. Now, today's losses drag all three major averages into the red for the week, but not too far. And since this is the last trading day of the month of August, let's look at how it's going out. Gains across the board. The Dow, the biggest gainer, as it got something of a reversal throughout the month. But check out the Russell 2000, up 7% in August. That's its fourth straight monthly gain, longest win streak since 2021. Gold, also a big winner in August. We got somebody who likes gold coming up. Right now, trading just below the all-time high of $35.34 an ounce. It set earlier this month. That is scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort. Morgan Brennan is off today. President Trump takes his problems with the Fed to court today. A hearing on whether he can fire Fed Governor Lisa Cook. We're taking a closer look at the public perception of that situation. Plus, shares of SentinelOne rising after reports last night of its earnings up 7%. The company's CEO, Tomer Weingarten, is going to join me coming up. Also, we'll be joined by the CEO of Gecko Robotics. He's got a different take on the impact of AI than what you might be hearing. But let's start with these big numbers. A 1% drop for the NASDAQ, 3% for NVIDIA. Christina Parts-Nevelis, what's going on?
I'm going to start with NVIDIA. I have to. Solid earnings, but fell, like you said, 3.5% anyway. Data center sales came in a bit light. There's still that China overhang. It's a classic case of good news was not good enough, and it has an outside impact on markets. Investors, though, are looking past the chips to the connectivity layer. Companies like Astera Labs that build the high-speed data highways between chips are just having their moment instead this week. Astera Labs, just a few weeks ago, posted record revenue up 150% from last year. Credo, that's also why you're seeing other names like Credo and connectivity names like Lumentum outperforming NVIDIA this week as investors really just target the plumbing between AI chips. Dell also validates this AI infrastructure boom, doubling its AI server forecast to $20 billion for fiscal 2026. The problem is margins are getting squeezed as they really just duke it out with Supermicro and Asian manufacturers who will take any deal to win market share. That's why shares closed over 8% lower today. And then there's Marvell sitting this party out. Their data center business missed estimates at $1.5 billion, and they're guiding flat for next quarter. Management calling it lumpiness in AI sales, but that's not what investors wanted to hear. Shares closed almost 19% lower today. Really, the AI gold rush is real, no doubt, but it's shifting from who makes the chips to who connects them all together this week. And right now, everybody's fighting so hard for deals that profits are just taking a little bit of a backseat. John?
For sure. Christina, thank you. Well, let me revisit the Dow here. It actually closed down less than 100 points, a little rally there into a close, I think about 92 points. Now let's turn now to the bond market as the latest reading on inflation comes right in line with expectations. Rick Santelli's got more on that from Chicago. Hey, Rick.
Yes, John, it's the tale of two different maturities when it comes to treasuries. The first maturity I'll discuss is the long end. If you look right now, everything above a 5-year note, yields are higher, even though all maturities yields are lower for the week. Why is that? Because the long end, 10-year, 30-year, they looked at the notion of not inflation moving down, but growth moving up. And where was that growth moving up? 0.4 on income, 0.5% on spending, up 0.3 on real spending. These are really good numbers on the personal income and spending. But the short end, most closely associated with the Fed, it was looking at what was going on that would affect the ease that's coming up in a couple of weeks. Look at a 2-year note chart. And what you should notice is it made its first low yield when it saw there was no surprises on the personal PCE inflation numbers. Then the next chart, well, this chart, you can see we've basically touched this 360 area recently. We touched it in April of this year. We touched it last September. So basically, you see that we have this long-term downward pressure on 2-year note yields. And that really is, whether it's the growth is pretty good, but the labor market is questionable in the Fed's eyes. Inflation doesn't seem to be a problem, and the yields are moving down. So what did that do to the Fed expectations? Well, right now, these Fed fund futures, you see that 1-week chart there, the higher it goes, the more easing's built in. And right now, it's got almost a 90%, closing in on 90% chance that on the 17th, we're going to get a 1/4 point ease. So the curve has steepened. And this type of steepening is a good type of steepening. Long end likes growth. Short end likes that the Fed can still ease with the combination of growth and less inflation. John Fort, back to you.
Sounds like we can have a weekend then. Rick Santelli, thank you. Well, let's stay on the market. Bring in Unlimited CEO and CIO Bob Elliott, the gold bug I mentioned before. But let's start with the Fed and what's going on there. You think Powell's caving?
Well, I think basically when you look at the change in his statement at Jackson Hole versus where he was just a few weeks before in the presser, it seems like there was a pretty material shift in the positioning, particularly getting to a focus on the labor market. I mean, I don't know how many times in the last presser he basically said the labor market's strong, it's tight, there's nothing to be concerned about, and then all of a sudden he changes his mind.
Got those jobs numbers right after that, didn't we? And those revisions too?
Yeah, I mean, those job numbers, I think most people who follow the jobs numbers would have expected some revisions that are not that far off of what happened. And remember, the Fed traditionally focuses on labor market tightness, meaning the unemployment rate. And that's remained relatively stable because of the, how did he describe it, the curious slowdown in labor supply at the same time that there's been a slowdown in labor demand. And so if the Fed was really focused on its traditional mandate, the unemployment rate, there wouldn't be much to do here. I think the main thing that is a notable shift in the reaction function is focusing on the overall growth rate in jobs rather than focusing on tightness.
So what's the impact on equity investors then, and how much is riding on that next jobs number due a week from today?
Well, I think for most equity investors that are really hoping for these cuts to come, the type of numbers that are going to deliver the Fed cuts are probably not the type of numbers that they're going to be happy with from a growth perspective. Look, if we start to get, very low or even negative prints in jobs, which is what Waller suggested earlier this week, looking at some timely numbers, that's a pretty bad environment for equities, particularly as they continue to press near all-time highs. And so I think that's the basic tension that exists here, which is that the cuts may come, and that may be good for the economy over a longer time frame, but it may not be good enough, fast enough for the equity market that's expecting strong growth ahead.
What did you think of these inflation numbers?
Well, I mean, who cares about inflation anymore? The only thing that matters is jobs, right? I mean, I think that's basically what Powell said in the Jackson Hole speech, which was essentially no matter what the inflation numbers are, at least for the next year, while tariffs are on the table, they're looking through those numbers.
Well, that's what Powell said, but look at Caterpillar, look what Gap is saying about the impact of tariffs on pricing and on their profits. What should investors take away from that about what to expect out of these companies and out of the economies in the quarters to come?
Well, I think the main concern for equity market investors is that rising inflationary pressure as the tariffs sort of are going through the python out the end to face consumer prices, to raise consumer prices, is that unless consumers are increasing their incomes, which with a weak labor market they're probably not, that basically has to come that higher prices has to come out of real spending. And so we've seen a pretty weak consumer. I agree today's data was marginally positive, but if you look over the course of the first half of the year, consumers were already spending on a real basis about half the pace that they were in the previous 2 years. And so if inflation passes through, we see prices rise and consumers don't have more to spend, that's probably going to hit real consumption. And real consumption really is the backbone of the whole economy. There's only so much this economy can do without the consumers consuming.
Curious what we get in Q4 then, the holiday season. We'll talk about gold, if you will. What's the function in your portfolio? Does it change at all under these conditions?
Well, I think gold's really proving out that of all the assets that you can hold to protect yourself against, let's say, interference in the Federal Reserve and the devaluation of the dollar, that's inconsistent, let's say, with overall economic conditions. Gold's the only asset here. You look at the board today and you basically say, gold is proving itself as a contra-currency as concerns about the Fed rise, and things like cryptocurrencies, which are claimed to be digital gold, are pretty clearly showing themselves as risk assets. To be clear, as they have time and time again. There's only one gold, and that's the yellow metal.
All right. I know you love it. Bob Elliott, thank you.
Thanks.
Have a great weekend. Well, coming up, we're going to get the latest on President Trump's effort to fire Fed Governor Lisa Cook, but we'll also ask the questions people on Wall Street and Main Street are asking. Should government officials be held to a higher standard, or do we just have to accept that even Fed officials and politicians aren't perfect? Overtime's back in 2.
Closes.
Welcome back to Overtime. President Trump wants to fire Fed Governor Lisa Cook. Does he have the authority? A court will decide, and the process began this morning. Eamon Javers has details. Eamon.
Hey there, John. Yeah, the court hearing today ended inconclusively in the sense that the judge here did not issue a temporary restraining order or any other legal action to stop the president from firing Lisa Cook from the Federal Reserve Board. There you see Abby Lowell, Lisa Cook's attorney, leaving after the lengthy hearing, about 2 hours of debate about the president's authority to fire people for cause. What does for cause mean is really at issue here. And one of the discussions, John, that they got into here was the question of motive. And that was one of the rare places where we saw agreement in this hearing, more or less. What the government said is it doesn't matter that the president has said it's a good thing for him to have a vacancy to fill on the Fed. It doesn't matter as long as the underlying allegation is there. We saw the president at this cabinet meeting earlier this month, and the president said that he wants a majority. And here's what the president said in the cabinet meeting. He said, we'll have a majority very shortly on the Fed, he's referring to. Once we have a majority, housing is going to swing and it's going to be great. People are paying too high in interest rates. That's the only problem with housing. We have to get the rates down a little bit. So the Department of Justice said, look, the president can be happy to have a position to fill here, but that doesn't bear on the underlying allegation or his authority to fire or not fire. And interestingly, Abby Lowell here, the lawyer that you just saw on your screen, conceded that the president could have what he called a bad motive. He said presidents can have a bad motive, and he put a little dig in there by saying, and especially this president could have a bad motive, but the underlying allegation stands as cause. So the question now is, what does for cause mean? That's going to be up to the judge here to decide. She's expecting some more filings early next week. We may get a decision on this in relatively short order next week in terms of whether she issues some kind of injunction to stop the president or lets that firing go forward. John, back over to you.
All right. Eamon Javers, thank you. Now let's turn to the Fed side of the equation. The attempted firing of Cook is the latest attack on the Fed from the president. Steve Leisman with me now. Steve?
Yeah, John, I'm going to say Fed officials and investors are watching these Cook proceedings with the same questions. Is this a big issue where Fed independence is at stake, or is this a one-off limit to the specific mortgages and alleged wrongdoing of Fed Governor Lisa Cook? Here's the bigger view, that the president has hounded the Fed to lower rates repeatedly. The president has asserted authority to fire almost anyone who he deems is exercising executive authority. And administration attorneys argued today, as Eamon just said, that for cause is broad, linked to the president's judgment of the ability of a person to do the job, but not a policy disagreement. In that case, the Fed independence could be at risk. Depending upon how the judge rules, the president could end up with substantial authority to fire Fed officials, quote, for cause, and that could mean without any due process. But the Cook case can also be seen in smaller terms. Cook has issues surrounding 3 mortgages. We know that to be true. She has not explained these issues, and the firing could just be limited to a Fed governor with obvious issues. In that case, Fed independence is less at risk. Even if Fed officials and investors see this as small, there are still potentially big implications unique to this presidency. Cook's firing would give the president a 4-3 majority on the board. Depending upon who he picks, these officials could end up having less loyalty to the Fed as an independent institution and more to the president and his desire for lower rates. That may be the case no matter what the judge decides. Given the public relations, it could be difficult for Cook to stay in office unless she sufficiently answers the questions about her mortgages. Even then, the die already may be cast. So next stop, the Senate and Senate banking, and especially Senate Republicans, and what criteria they demand of one, or John now, potentially 2 new Trump nominees. And I'll just say one thing, John, I've been hounding all week this issue of the administration did not ever question, as far as we know, Lisa Cook. And the judge made a pretty big deal of that. And I'd say if she does get some relief, it could be because of that failure on the part of the administration. If she doesn't, it could be because she never really made her case.
It seems there's another interesting aspect of this, at least for me, and we have this whole idea right now of what cancel culture is in the internet era. There's so much more information that's findable about everyone, and you can shape public opinion much faster in the age of social media. So is it possible to, in a way, invent cause for the cases that you want to? Does cause mean something different, I guess, in this environment than perhaps it did a couple hundred years ago? I don't know if the judges are going to consider that or how much that bears on Fed independence if perhaps for anyone, whether it's a real estate issue or a mortgage issue, perhaps the president can find cause.
Yeah, I mean, that was it was a big argument of the Cook camp today and in her filings that it's an allegation until it's proven. And then as we talked to Scott Alvarez, the general counsel for the former general counsel for the Fed, he told us, look, if the for cause is untrue, there's no cause there. And one other very interesting note, John, that perhaps viewers should now make sure that they are checking Twitter on a regular basis. The judge was a little incredulous that the administration argued that Cook was informed of these charges through a tweet. And the administration argued she had 5 days after the tweet, actually, in some cases, a half an hour, because you'll remember Bill Pulte put up that tweet, put up that information, and then a half an hour later, the president stepped forward and said she should be fired. The administration said, hey, she had 5 days after this was public on X to respond. And the judge was like, wait, you're saying that's a response? So we are very much, maybe, John, in this internet age here where a tweet is notice.
What a world. Steve Leisman, thank you. So with all these developments, can Lisa Cook survive Trump's ire, keep doing her job? Joining me now is Brett Bruin. He is the president of public relations firm Global Situation Room. Brett, this is a unique historical moment. No president has attempted to do this. Do you think Cook has a shot at keeping this job? Should she?
Well, if she does, it may depend largely not on what happens in that D.C. courtroom, but in fact in the court of public opinion, John. And that's where I think, it's interesting. It was mentioned that she has not been publicly responding to these allegations. Even if she cannot, I think it's important, and certainly what we're telling clients who face these kinds of accusations is you've got to have somebody, an ambassador, an amplifier, a validator that's out there speaking on your behalf, that's informed about the issues, because right now we unfortunately really just have one side of the story, and that is not a complete picture in terms of what the facts are here and certainly how this issue is going to be litigated in the court of public opinion.
The court of public opinion is interesting in this situation to me because it's not convened equally in all situations. The Defense Secretary Pete Hegseth certainly has had some issues with his confirmation and then with this signal controversy. The president stands by him, though some might argue, some in the public have argued, that he behaved in a way that was inappropriate. But in this case, with an institution that's supposed to be independent from the executive, it's a bit different. How do you parse that?
Well, what's interesting here, John, is it does seem to come down to a few political figures. And what we saw, for instance, with Matt Gaetz is that there were certain senators that came out publicly and said, look, this is beyond the pale. Even if we support the president, we cannot have someone who has these kind of allegations out there. With Hegseth, it seemed like we might get there, and yet, with a number of key senators, it just didn't cross the line. And so I think, once again, with Lisa Cook, it comes down to a few key political figures. If we hear Republican senators, certainly those, on the Senate Finance Committee and others saying, hey, this may not be good for the economy, this may not be a precedent that we want to set. And John, I think that's an important one to keep in mind, especially as we head towards next November and the midterms. What is the kind of precedent that Republican members of Congress are going to want to be setting here?
So this sounds like something different than what we thought of independence meaning before when we talked about the Fed. Public opinion and the president's unique ability to bring that to bear, no?
It is. And yet, look, the president does not have a monopoly on this. And, I was just on a client call earlier where I was saying, we've got to account for the fact there has been a lot of shock and awe over these first 9 months, but the dust is going to start settling. So for investors, obviously also for members of the Fed, it's important to look at the months ahead. We've got elections in November. That will be a barometer, one that could take a lot of air out of the president's sails. So I think, the smart investors, the smart officials are going to be looking beyond the horizon to understand what's going to happen with the president's bully pulpit 3-6 months from now.
Okay. Brett Bruin, thank you.
Sure thing.
Coming up, we are tracking some of the day's big movers. We're going to tell you why Affirm is soaring, and we'll talk to the CEO of Sentinel One about his company's quarter. That's being cheered by analysts, at least 6 price target hikes. Overtime, we'll be right back. Welcome back to Overtime. Shares of Caterpillar, the biggest drag on the Dow today, down about 3.5%, accountable for nearly all of the Dow's point losses. The company increased its estimated tariff impact to as much as $1.8 billion for 2025. Those tariffs on steel and aluminum imports, as well as the tariffs on products from various countries, are going to weigh on Caterpillar earnings. Well, it's time for a CNBC News update with Julia Borston. Julia.
Hi, John. Secretary of State Marco Rubio says he's handing over the role of acting USAID administrator to Budget Director Russ Vought. In a social media post today, Rubio said Vought will oversee the agency's closeout, with most foreign assistance stopped. Vought will serve as agency head amid several lawsuits against the agency's closure. The Trump administration likely acted unlawfully when it ended protections for 600,000 Venezuelan migrants. The 3-judge panel of an appeals court unanimously voted today to uphold a lower court ruling to keep the protected status in place while the case continued through the courts. The Department of Homeland Security said the ruling, quote, undermines the integrity of the immigration system. And rideshare companies Uber and Lyft agreed to back a California bill that would allow drivers to unionize and collectively bargain. Governor Gavin Newsom said today the rideshare drivers will remain classified as independent contractors, which he said would empower drivers while making the services more affordable for residents. Back over to you, John.
All right, Julia, thank you. Well, shares of Ambarella soaring nearly 17% today as its results beat estimates and it raised guidance thanks to strong AI demand. And while AI has unquestionably been great for the stock market over the last couple of years, concerns remain for people Will AI take our jobs? For companies, will the investments pay off in productivity and then profits? We will examine those issues coming up on Closing Bell Overtime. Patriots.com. Welcome back to Overtime. Stocks closing lower for the day, dragging all three major averages into the red for the week. But August still going into the books as a positive month for the markets. A 3% decline for NVIDIA weighing on tech today. Dell and Marvell also with significant declines. Gold's higher by 1%, getting close to its record high. Bitcoin and Ether both falling for the day and the week, and we are 2/3 of the way through the year. S&P 500 up just south of 10%. Any gains in the next 4 months and 2025 will be the third straight double-digit percentage gain for the index, the sixth year in the last 7. Well, two major ways AI promises to change work: shrink the workforce and boost productivity. On the productivity side, companies are seeing green shoots in small experiments, but for many, wide-scale efficiency remains elusive. On the employment side, jobs are already shifting, especially in big tech. Mackenzie Sigalos has more. Mac.
Hey, John. So I've been digging into new data showing disruption up and down the employment chain. Stanford is tracking real-time payroll data from ADP, and they found a 13% drop in employment for workers under 25 in jobs most exposed to AI. And at the same time, the Mag 7 are clearing out middle management. Our Jen Elias obtained leaked audio from inside Alphabet, where executives disclosed they've quietly cut 35% of small team managers in the past year. Microsoft shedding 15,000 roles just this summer, and Amazon's Andy Jassy has been pushing since last fall to flatten their org chart. Mark Zuckerberg's year of efficiency, that's already years in. Now, cutting back middle management, that does two big things. It frees up resources for the AI race, and it removes layers of leadership that slowed down product cycles. Google's former HR chief telling me that the workplace transition underway now out here in Silicon Valley, that also shows new efficiencies inside these big tech names and how companies are deploying their own generative AI tools internally, with one manager able to do the work of 3.
Sounds great. All right, now thank you, Mackenzie. Well, now on to the productivity side. Why isn't AI having a bigger impact yet? Joining me here on set is Jake Lucerian, Gecko Robotics, co-founder and CEO. Gecko came in 30th on this year's list of CNBC disruptors. There are only 50. His piece in Fortune this week is titled AI's Dirty Secret. Without data, it's just math tricks. Jake, so many companies either don't have the data, you argue, to do a really great job with AI, or their data is siloed in a bunch of different places, is what I'm hearing also. How long does it take for that to come together?
Well, it's great to have you on, or great to be on here. But I think the thing that I've been really shouting from the rooftops, I guess, ever since Davos and 12 months before that, was if you don't have great data sets, especially in these sectors like energy and manufacturing and defense, public infrastructure, it just is impossible to be able to use your incredible algorithms to create efficiencies. And while
that's part of what you do.
It's part of what we do. That's why I created the company. And I think that what you're seeing with the job decreases for that age group in those kind of companies makes total sense, probably going to go up. But what you're seeing is a 4-person leaving, 1 person coming in those industrial sectors that I mentioned. And there is a cry, and the reason I built the company was because I knew that AI was going to be an accelerant to reducing that barrier to entry to get folks to be able to have great, high-paying, safe jobs in these sectors. And by the way, it's extremely important right now as it relates to winning the AI race.
And Gecko, you've got robots that go out and crawl on infrastructure and figure out some of how it's doing, what's wrong with it, right? It's like that pill that you can swallow that goes through your insides and sees if you're healthy. But for stuff in the economy. And it's interesting to me, you got Gecko, you got Samsara, you got a number of companies out there that are trying to, as you put it, turn atoms into bits so that there's data that companies can do something with across the whole economy. Do you have customers who are now able to bring AI to bear on the data that they're collecting, and kind of case study examples you can give that show it's working?
I do, and this is where the real conversations that I have is a lot of frustration actually from the CEOs of whether it's the biggest metal manufacturing companies in the world, energy companies, mining companies, and even the folks on the defense side. It is, look, we're getting sold a bill of goods they're being sold to us. The return is not there. The ROI is just like not practical. So what are you doing? Why are you different? And I think the thing that we have to understand is that while the algorithms are incredible, and we see that every day with the functions in everyday life that we use ChatGPT for, that sort of impact is just not happening in the industrial sectors. The questions that they're asking me are, how can you help me improve my heat rates so I can reduce the BTUs, increase the kilowatts of my power plant? How can I reduce days of shutdown? How can I eliminate forced outages and explosions at my facilities that kill or reduce our production? And I think the answers that we're able to give is, you give us 1x in terms of the data sets that you already have, we'll give you 10x by sending wall climbing robots and walking dog robots and drones and fixed sensors that are looking at vibration and temperature and the integrity of the metal that's running all these things. And we will help to unlock the efficiencies of predictive maintenance and also efficiencies gains in the way that they run their facilities. So we show that time and time again.
There's some industries, some companies that have a huge incentive because of the profits that they make, or just the revenues, I guess, that they charge, to go ahead and invest in this and drive it. But I imagine there are other sections of the economy where they might not have the capital to have robots go out and crawl and do that. Is this something where the society, where governments need to decide this is worth investing in because of the efficiencies that our economy is going to get from having that data?
Yeah, look, I mean, I spoke on stage at the winning the AI race out in D.C., and this was the big thing I was talking about, is those that win the data race are going to win the AI race. And most people think about algorithms are much more important. Data will always be there. And in the physical space, the world that we live in and drive over every single day like a bridge, the data just isn't there. And you cannot drive these Ferrari-like algorithms if you don't have any fuel to put inside of them. And that is the data. You have to lay the rail before you can drive the engine over it. And so that means decoding the real world, decoding the physical world, this world that was forgotten about by Silicon Valley, that's not digital. It didn't experience the fourth industrial revolution. And now it's time, because now you can realize the impact and importance that AI can derive and bring in these sectors. And now winners and losers are going to be more clear. Okay. And I think what's interesting now is I'm seeing a motivation from these CEOs with the impacts that companies like ours are being able to show that, okay, this is a real chance where winners and losers and the big company, the big companies that exist today might get usurped coming forward for those that adopt the quickest.
All
but
right.
it must be pragmatic or it's worthless.
Jake, thank you.
Yeah, thank you.
Jake Lucerian from Gecko. Well, up next, how one fintech company is helping to offset some barriers to doing business that are being raised by President Trump's tariffs. Plus, Wall Street will face a barrage of jobs data next week. Coming up, we'll discuss whether those numbers will be the next catalyst for this market. Overtime, we'll be right back. Financial technology upstart Affirm soaring 10.5% today on results that grew some investor confidence that it can gauge consumer creditworthiness better than traditional credit card companies. Today, let's take time out with a founder whose company is making similar moves in global remittances. Matt Oppenheimer, CEO of Remitly, a fintech with a market cap around $4 billion. He started Remitly after a stint working in Kenya as Barclays Bank's head of mobile and internet banking initiatives. The experience showed him that moving money globally was just much too hard.
Because I was getting paid in British pounds, because I was working for Barclays, I was living in Kenyan shillings. I eventually had to get money back to US dollars. was expensive, it was inconvenient, all the things you'd expect. But more importantly, a lot of my Kenyan friends were receiving money from their loved ones in primarily Europe and North America. And there were just these stories of one of my friends having her sister's Bank of America debit card that she would take to an ATM, and that's how she'd kind of get money from her sister.
Now, Remitly, Oppenheimer is embracing stablecoin technology and AI to make it easier for people to send money around the world. And then there's Remitly Flex, a new feature that gives some U.S. users the ability to send money overseas and repay it later.
Instead of having to wait 3 days for the funds to arrive, with our send now, pay later solution, Remitly Flex, those funds are available instantly. And so we have unique data and analytics to be able to bridge the gap that has existed for a long time, which is a gap between credit access and credit worthiness. And looking at a lot of the data that we have in terms of payments and remittance, international payments data, we have the ability to, I think, build a great product there that really benefits our customers, and that will be part of Remitly One.
So the timeout takeaway, global credit, even as tariff barriers and immigration changes are introducing new challenges in the global trade picture, technology is lowering some barriers to doing transactions. Investors can start thinking about which players will benefit in the fintech space. While Sentinel One shares popping on a profit beat and strong third quarter sales guidance, the company's CEO is going to join me next for an exclusive interview on the quarter and the outlook for cybersecurity demand. Plus, Broadcom is the big name that's next up on next week's earnings calendar. We're going to discuss whether that could be the next big catalyst for this market later on Overtime.
Co.com.
Welcome back to Overtime. A bright spot and a down day for tech. SentinelOne, the cybersecurity company, raising its annual sales forecast after its Q3 guide came in above estimates. Annualized recurring revenue rose 24% to $1 billion. That's why it's up 7%. Joining me now in exclusive interview is SentinelOne co-founder and CEO Tomer Weingarten. Tomer, good to see you. So execution, a big theme here, but also somewhat AI. How are these threats in an emerging AI world emerging, and how is that driving demand for your product?
Well, AI is accelerating everything. So obviously it's accelerating also what attackers and adversaries can do. We're seeing that companies are trying to also adopt AI, and that creates even more risk for them, especially with the current state of security for these, LLM models. They are just not as primed for production usage. And I think this is where security becomes this, incredibly important pillar to ever get these solutions to be production grade. So these are things that we're absolutely benefiting from. Our AI offerings are designed to get folks to a secure adoption of generative AI. And I think that's part of the uptick here.
So in what way is this introducing vulnerabilities? Are these code assistants writing insecure code?
It's a lot of data leakage. It's a lot of non-accurate production, I would say. If you kind of think about, everything that's happening right now with AI, this need for security, the need to know that what the model is doing for you is predictable and has the proper guardrails is just an imperative. And then the data that people share with that model can also often lead to leakage. If there's no control over what employees are putting into these models, into these applications, it becomes a nightmare for enterprises trying to wrangle what is being put into these models, both for sanctioned usage, but also for complete shadow AI unsanctioned usage. And everybody's just clamoring for visibility and control over what's being done right now in any enterprise environment.
So why is that driving more big deals for you? I think you said deals at more than $100,000 of annualized recurring revenue are now at 1,513, representing a 23% increase?
Yeah, I mean, a lot of it is driven by our own AI offerings. I mean, we've been building AI products for over a decade now, in production across tens of millions of devices and workloads, in a complete productionized way. So when customers are looking to adopt generative AI, what we can offer them today in terms of the level of control and visibility is quite unique in the market. And if you join that with the level of automation that we can provide, then you're getting it to the point that we help these enterprises get their data, sanitize their data, filter their data, and get to process it in real time and layer it with AI. And that's obviously, a pretty priceless component.
And tell me, what is SentinelOne Flex as a licensing model, and how is that helping on the revenue side?
Yeah, Flex is, our new contract vehicle for customers. It just allows them complete access to our platform and the choice to use whatever they need at the time that they need it. So it's just a superior way to transact with customers. And obviously it leads to more platform adoption, more consumption, and again, just more flexibility for customers, which is the prime thing we're trying to accomplish with this.
Is AI changing the number of employees you need?
It is as it is for everybody. I think that right now, the way to think about it is that there are multiple processes that you can probably automate today. I think most generative AI usage we're seeing today is almost relegated to very narrow workforce automation and workflow automation tasks. As it becomes more accurate, as it becomes more secure, I think you can start seeing it span even beyond that. But right now, I think adoption is relatively narrow. We all need to establish more trust in these systems. They need to become more predictable. And that's exactly why, SentinelOne is building AI security to enable customers to deploy AI in the safest way possible.
All right. Tomer Weingarten, CEO of SentinelOne. Thank you.
Thank you, John.
Well, next week, we'll get earnings from Salesforce and Broadcom, as well as the August jobs report. Up next, we'll look at whether there's an even bigger market catalyst that should be on your radar. And don't forget, you can catch us on the go by following the Closing Bell Overtime podcast on your favorite podcast app. We'll be right back.
Peacock.
Welcome back to Overtime. Let's get you set up with next week's trade. The markets are closed Monday for Labor Day, but it'll be a busy week on the economic front. We'll get ISM manufacturing and construction spending on Tuesday, the job openings and labor turnover survey, JOLTS, factory orders, auto sales, and the Fed's beige book will be out Wednesday. On Thursday, we'll get the ADP employment report, weekly jobless claims, and ISM services. And then the week's going to close out with, of course, the highly anticipated July jobs report. On the earnings calendar, we'll get Signet Jewelers and Zscaler Tuesday. Wednesday brings Salesforce, HPE, American Eagle, Dollar Tree, Macy's, and Campbell's, and Broadcom's the big name on Thursday, along with Lululemon, DocuSign, and UiPath. Now, our next guest joins me with key things to watch next week, which bring in Vital Knowledge founder Adam Crisafulli. Adam, let's start with the retail consumery sort of stuff, because I think Dollar Tree and Campbell's in particular, interesting because of what they do. They've got some unique issues, though. I wonder which wins out in this economy, the fact that they're kind of dealing in inferior goods or the problem that they've got to deal with tariff costs.
Yeah, it's a great question. From what we've seen out of other packaged food companies and other retailers, there's definitely been a dichotomy in those two sectors. The packaged food companies, especially the ones we saw this week with Hormel and Schmucker, did not have great earnings. Those stocks suffered. The retailers have actually had a pretty decent July end quarter, with very healthy sales. A lot of them are seeing pretty stiff headwinds, especially from tariffs, and that's pressuring margins, but they are managing to kind of work their way through this very difficult environment. The stocks have not responded all that well, but as far as just the actual numbers, the retailers have had a healthy earnings season. Packaged food, consumer staple companies, not so much.
And then in tech, we've got Salesforce and Broadcom, and this sort of reminds me, you can kind of compare and contrast with the hyperscalers like Microsoft, Amazon, a smaller version in Salesforce, and then you've got NVIDIA and a smaller version of the chips AI play in Broadcom. I mean, do you think we're going to get insight into how deep the AI demand goes and the AI innovation perhaps from these two names?
Yeah, definitely. I think Broadcom's going to be crucial, especially after what happened last night. You had a bunch of kind of underwhelming reports out of the AI-linked names. And so tech very much is kind of at an inflection point right now. The space has not traded very well. There's been evidence of a rotation out of tech and into some of the more unloved areas of the market. So, Broadcom's going to have a lot of pressure on its back when it reports. And then within tech, software stocks have underperformed for the last several months, due in part to fears that AI would disrupt a lot of your traditional enterprise vendors. And in the last couple of days, we've seen decent software earnings reports. MongoDB was a big name this week on the upside. And so for Salesforce, I think you've actually seen its sentiment improve a little bit ahead of its report Wednesday night. So those two names very much in focus next week, absolutely, for tech.
We're going to get a little culture war action. We were talking a lot about Cracker Barrel this week, but American Eagle reports next week. We're going to have to be reminded what it means to have good genes, maybe some Sydney Sweeney talk. But when it comes to that stock, how much of that halo from that marketing campaign perhaps gets questioned and how it's going to translate now?
Yeah, I mean, that's definitely, it's a battleground name. And not only do you have Sydney Sweeney, you have Travis Kelce also had a marketing agreement with American Eagle. So definitely there's been a lot of noise and hype around that stock. I don't necessarily think it matters so much for the broader macro landscape, but investors will be very curious to see the extent to which those two partnerships either hurt or help sales in the quarter.
Lululemon going to be anything to watch?
Yeah, definitely. I think, like I said, for retailers in general, the sales environment seems to have been pretty decent. Consumers remain resilient, are still spending, but a lot of these companies are going to be absorbing some very significant tariff headwinds, at least in the near term, before they can adjust their businesses, maybe push through some price increases to compensate for that. So Gap last night was a great example. Decent sales numbers over the Athleta brand underperformed expectations, and they acknowledge that they're going to have a very large tariff headwind in the second half of this year, and that's going to probably be the story that Lululemon tells as well.
We'll see if DocuSign is making that turnaround continue to happen, yes?
Yeah, DocuSign as well is another enterprise software name that people will be watching closely.
Appreciate it. Adam Crisafulli, thank you. Well, before we go, take a look at shares of Spirit Aviation. Spirit Airlines filing for Chapter 11 bankruptcy protection. for the second time in a year. Shares are down more than 45% after hours. Rough go for that particular name. And it's been kind of an interesting close for the week on the major averages, with all of them lower, still positive for the month of August. However, one more month in the quarter, and there's been plenty of market action for sure. That's going to do it for overtime. Fast Money starts now.
Happy Friday, live from the NASDAQ market site in the heart of New York City's Times Square. This is Fast Money. Is it a fizzle to the summer sizzle? Stocks hit to end the week. Does this set the stage for a September swoon? Plus, the results roll on. Another big slate of earnings on deck next week. How options traders are setting up ahead of all of it, like Broadcom, Salesforce, Lululemon, and more. Plus, crypto's rough week, placing your bets ahead of sports betting's biggest season, and maybe, just maybe, the most important charts right now. Your traders lay out what they're watching, and on your desk tonight, ahead of the three-day holiday weekend, literally on your desk tonight, to my right is Stephen Grasso. We got Mike Coe and Julie Beal with us as well. We'll take it.